Modern economics promised growth, stability, and prosperity, yet financial crises keep repeating, debt keeps rising, and inflation never really leaves. What if the problem isn't poor management, but the system itself? Global debt has surpassed $300 trillion. Inflation is no longer a temporary shock. It has become a structural feature of the global economy, and the entire system depends on one assumption: that debt can keep expanding forever. Islamic economics begins by questioning that assumption. Welcome to Eqtsad Global, your global Islamic economy hub. What is Islamic economics? Islamic economics is often misunderstood as simply banking without interest. If it keeps moving, the system lives. If it stagnates or pools at the top, the system collapses. Core principle. At its core, Islamic economics is built on a single stabilizing idea: wealth should not circulate only among the rich. This is not just a moral statement, it is an economic one. Concentrated wealth reduces demand, increases fragility, and amplifies crises. This principle is so central that it is explicitly stated in Islamic economic thought, so that it will not be a perpetual distribution among the rich from among you. The three pillars of stability. To understand how this system works, we need to examine its three foundational pillars. Pillar 1, the prohibition of riba, interest. In conventional economics, money is treated as a commodity. In Islamic economics, money is a measure of value, not a product that generates profit by itself. Just as a ruler measures length, money measures effort, productivity, and exchange. When money earns money without risk, debt expands faster than the real economy. That gap is where crises are born. Pillar 2, risk sharing. Islamic economics replaces guaranteed interest with shared risk. Instead of one party bearing all the downside, both the financier and the entrepreneur share outcomes. Profit and loss move together. This forces capital to flow into real assets, real businesses, and real productivity. No abstract leverage, no detached speculation. Pillar 3, zakat and active capital. Zakat is often misunderstood as charity. Economically, it is something far more powerful. It is a 2.5% charge on idle wealth. Unlike conventional taxes, it does not punish productivity. It penalizes hoarding. Capital is pushed out of vaults and back into circulation, stimulating demand and supporting the most vulnerable. Why this matters in 2026? Why does this matter today? Because the world is reaching the limits of debt-based capitalism. Asset bubbles grow faster than incomes. Financial markets detach from real value. Islamic economics offers what can be called a resilience model. Every transaction must involve a tangible asset. No ghost money, no hidden leverage, no excessive uncertainty. Islamic economics is not a religious niche. It is a systemic critique of how modern economies allocate risk, debt, and wealth. And it offers an alternative logic, one built for stability, shared prosperity, and long-term resilience. This channel is dedicated to exploring that alternative. We bridge ancient economic wisdom with modern financial realities. If you're trying to understand why the global system feels increasingly fragile and what a more resilient framework could look like, you're in the right place. Subscribe and let's rethink how wealth should work.